I always ask founders, like, what are you optimizing for? If you're only optimizing for valuation to protect dilution, let's have that conversation. We're not an IRR business, we're a MOIC business. So if we don't believe that this business can generate 4 times our money in 3 to 5 years, it's just not for us. So hi, I'm Florian Wojewodzki. I'm a partner at Iris Ventures. We're an early growth consumer focused fund headquartered in Barcelona with a satellite here in London where I sit. We're currently managing just over 225 million euros across 2 funds. We invest in, I would say, almost exclusively Series A, Series B branded consumer propositions. Largely in terms of geo focus, I would say 80% of what we look at is Western Europe plus UK. And then more opportunistically, up to 20% per fund is deployed in the US market. So our check sizes now with this new fund, I would say kind of out of the gates are in the 7 to 8 million euros. And then we can step up ultimately to 20 million euros inclusive of follow-ons, as we always reserve capital to support our founders across rounds prior to exit. We lead or co-lead all rounds. That's kind of an absolute must-have and requirement for us, just in terms of the way we work and wanting to sit on board seats and really flex our muscles to support our founders. And in terms of ownership stakes, of course, the more the merrier. We are very diligent, spend a lot of time to build conviction around every single one of our investments. So we typically underwrite to anywhere between 15 to 25% of ownership. In some instances, we own more of the business, and I think that's really it. I mean, we've made 2 seed investments, just for full disclosure. So as I said, we have flexibility to do seed. The bar is very, very high. I would say, loosely, we probably do 1 to maximum 2 seed investments per fund, just because we want to make sure that we have, as a team, and we're a relatively lean team, the bandwidth to support the founders the way we like to support.
Yeah. Well,
hopefully that gives you an overview.
It definitely does. And when we're speaking before we start recording, I say, you're my first. You always remember your first kiss, the first time you tasted this amazing dish, and then my first growth level CPG investor after 130 episodes. I finally found my first, so I'm excited about this conversation.
I'm honored, and I appreciate you inviting me.
It's definitely. Tell me a little bit about what let's say Series A means. What do I have to achieve to be considered the right fit for you? Let's say this traditional one, not the seed one. We'll maybe cover that a little bit short.
Sure.
But what kind of metrics do I need to be hitting as a business to be, say, Florian, maybe that's a really good fit for us?
Yeah, it's a fair question. So I think Series A, it's a pretty broad spectrum in terms of size of round, stage of business, particularly if you look at kind of more traditional tech. So just in regular way CPG land, in terms of how we think about it, this is typically a business that's doing 3 million plus euros of revenue, right? So that's the first thing. It's like, that's kind of the starting point for us for Series A, is 3 million plus, just so we can at least roll up our sleeves and understand, okay, is there product market fit? What's the real traction? What does the community look like? What does repeat look like? That's the first. We have a long list of criteria as we think about every opportunity. Obviously, every investment we make, the criteria mix that's been fulfilled is very different. Sometimes we over-index on founder strength. Sometimes we over-index on fundamentals. So it's not every case is very different. But I say from a kind of financial metric standpoint, it's top line, it's capital efficiency. So is this a business has the business burned 5 million euros to get to 3 million of revenue, or has the business only raised 300K and is burning a very, very sensible amount of cash per month, right? So I kind of think like capital efficiency, top line. I think the standard metrics around gross margins. If this is an inherently low gross margin business, and even with scale, when looking at the business plan, gross margins really aren't going to creep up or expand a whole lot. That for us is challenging, right? Because it ultimately challenges the business model and bottom line. And it's ultimately going to be, in our view, painting a very broad stroke of quite a cash, capital intensive business model where it's going to be burning for many years to come. We don't typically underwrite to businesses that have 3-4 years of forecasted cash burn. I think in a pretty conservative case, we're comfortable with a sensible burn of a couple of years, as long as there's a real path to break even. And again, it goes back to, what are the other metrics that support that conviction, in terms of what is the repeat, what does churn look like? What are the unit economics of the business model? So that's a long-winded answer, but hopefully that kind of answers your question.
Yeah, well, take us through some of the venture math, maybe. Just give us from a founder. Okay, I'm doing 3 million. I have pretty good customer acquisition costs. Yeah, the rate of churn seems pretty good. I'm not 4 years away from being cash positive. Like, can you take us through when you raised a new $100 million fund, right? So a year and a half ago, something, or a year ago. Like, what are the expectations of what you have to give back, and then when? Like, how long would the hold have to be for you?
Yeah.
How much more dilution would you need to see when you're thinking about making a bet on the business?
Yeah. So the simple way of looking at it for us, we underwrite no exceptions to 4 times our money. So we're not an IRR business, we're a MOIC business. So if we don't believe that this business can generate 4 times our money in 3 to 5 years, it's just not for us. It doesn't mean it's not a good business. It's just not a fit for what we've promised our LP. So that's the first point. So if we can believe that, even if there's burn for 3 years, because again, every category and subcategory are very, very different in terms of gross margin profiles, in terms of what to expect from a CAC standpoint. Like everything is different, right? It's very nuanced. If we can believe 4 times our money, and if we can really believe that this is a business that will be EBITDA positive and get to where they need to get to from a top line perspective and really be an attractive asset to acquirers, we typically underwrite to strategic sale. But again, depending on category, sometimes it's more of a sponsor. Sometimes, in very, very rare instances, it'd be IPO, but we don't typically underwrite to IPO. Then I think that's exciting for us. If we do a seed investment, we're underwriting to a 10x or like an 8x, return for obvious reasons, for it to kind of be worth our while.
And that would be over 7 years, meaning that would be a 7-year hold there.
Yeah, in a perfect world, it would be like a 5 to 6 year hold. But we, as we build conviction and we think about the underwrite, we debate this internally a lot. There have been instances where we've gotten comfortable with absolutely everything, and we haven't been able to get comfortable with the exit because maybe it's an inherently more challenged and illiquid category or subcategory, and we've had to walk away. So we're really strict about, is there going to be appetite at the tail end of this investment hold to monetize our investment? That's really critical for us. So hopefully that answers your question. I think a 3-year hold is an incredibly aggressive timeline. We don't typically, we're very transparent with our founders, even at the term sheet level, we say, hey, here's what we promise our LPs and underwrite to. If none of this feels comfortable for you, then let's have a discussion and potentially part ways. So we're very, very transparent. On the point around dilution, listen, we try to have as much of the business as possible because we're putting a lot of money to work. And obviously, we'd like to put more money because and to achieve those MOICs, it obviously has a bigger impact, stating the obvious. But we really, really, really don't like coming into a Series A where the founders have been overly diluted in prior rounds. That for us is a real problem. And there have been instances where, unfortunately, and we obviously feel bad for the founders, they're so diluted that we've actually said, okay, listen, if we come into this round, we actually need you to be made whole a little bit by your current cap table, i.e. that they should be giving you back based on your performance, 5 points of the business or even up to 10 points of the business in extreme cases. Because as you know, if the founders aren't incentivized and have enough skin in the game and it is their baby ultimately, then you're going to have problems further down the line because you will have subsequent rounds and there will be further dilution. That's a really bad place to be in our view. So we're very sensitive around dilution. Again, in terms of dilution, it's a broad spectrum in terms of where we've seen founders at the Series A, Series B. But it's a very, very important point for us.
Is there a certain approximate, again, I'm just like kind of back in the napkin, I thought, okay, you say $8 million, you want to have, say, 15%. So, okay, so it's a post of like 60 million, 50 million type of situation, 40 to 60 million. So is there a certain exit number that you're thinking then the company has to hit in order to get you that money back? And therefore, a founder should basically make an assumption, okay, look, I know when I'm coming to Florian, I need to know I have an exit value of $500 million. With this more dilution happening in the next 4 years, otherwise there's not even a conversation happening. If I don't have a path towards $500 million or $250 million, right? Given how much equity he's going to own, he needs, because the venture math is pretty simple of he had made a promise of a 4x return. I need to get him there. Ideally, it would be more than that if I can. Florian would love me for it. Obviously, but, clearly.
For us, we always assume, let's call it anywhere between 10 and 20% dilution for the founders across rounds. In a perfect world, the Series A round is the last growth round. And after that, you have an exit, or the business is spitting off so much cash that it's, they can fund their growth. That's the best case scenario. It's rare, but the best case scenario. For us, we never underwrite to multiple expansion. So assume whatever multiple we slap onto revenue at entry, we're assuming conservatively that'll be the multiple on exit. Again, that can change. But really, we're just ultimately assuming we underwrite to kind of the exit will be a multiple off of revenue. The reality in some of these businesses, it's going to be off of EBITDA. And that's a really, really important nuance, because there can be quite a big drop. Like if you're off of EBITDA and suddenly the business has grown top line, but the EBITDA is still the margin is quite low, you can be really punished from a valuation standpoint. That can really compress your return, right? But to simplify, you really want to assume that the business grows 4 to 5 times top line, right? And again, that kind of goes in line with our MOIC expectations. So if you can grow the business from 4 to 5 times from a top line perspective in a cost-effective manner, we're in the money.
Okay, understood.
So that's how we think about it in a very simplified form.
Yeah, and then when you're thinking about what is, let's say, multiple of top line revenue, like obviously we're following what's been happening at Huel, Grum, like we get a sense of where those exits are happening. Are we looking at that like 3 to 5x top line revenue? Is that how you're imagining things, or is there something else that may impact the top line revenue? Consumer brand.
Yeah, I think again there's a range. I think we see this time and time again where early stage founders who are very much early stage and seeing healthy growth, when they do priced rounds, they tend to latch on to, of course, as you might want to, the highest multiple paid in the market. The reality that those are multiples paid by strategics that are going to extract synergies on businesses that are have generated repeatable high year-over-year growth and have a sticky repeat consumer base, and in most cases are highly profitable, right? So like you're paying a premium for those reasons. And again, it depends on subcategory within health and wellness, which within F&B, I think 4 to 5 times is it's a very, very full valuation. You better have really standout metrics to justify that price. I think 3 to 4, again, these are very broad strokes, is probably more palatable. But again, even a 3 times valuation, you have to be able to point to a lot of metrics that are standout relative to your peers. You already know this, Alex, like the founders, and I always ask founders, like, what are you optimizing for? If you're only optimizing for valuation to protect dilution, let's have that conversation. Because there have been many instances where founders have raised at the highest valuation possible, and they've really set themselves up for pain further down the line because they haven't been able to grow into those valuations. So it's a fine line. Like you have to be quite smart and sensible in terms of where you peg valuation. But we certainly at Iris.
That's something that kind of triggers my mind as in 21, I was involved in sales in a SaaS company that was doing last mile logistics at the height of COVID. And we raised, it was 40 times X top line revenue, right? And I was just like, so it's very funny because I come from that world also, like selling SaaS in COVID in last mile logistics, right? Last mile delivery. And it's just very funny when people are like, well, 3 to 5. Oh no, it's 4. 3. I just think about I can't believe we were raised.
It's a different realm. Yeah. It's a different realm for tech.
Totally
and to that point, we've seen it before where consumer businesses that sit at the intersection of tech and consumer, the founders tend to lean more towards tech valuations, and it becomes a little bit trickier in terms of those negotiations and discussions, because ultimately they're really less of a tech business and more of a consumer business. But ultimately, certainly at Iris, and hand on heart, we certainly don't have the reputation for underpaying. So we always pay very full valuation, because for us is when we make a bet, it's never for what we deem to be a B minus or B plus team. It's kind of an A plus asset in all cases. Like that's how high the bar is. And so for us, it's, well, sure, you should pay full price for the A asset, because it's going to be so much bigger in 4 to 5 years because it's a standout and differentiated proposition. That's the thesis. That's the viewpoint.
Yeah. Tell us a little bit about your bullishness around wellness and longevity. You made a few bets in that space, obviously the beauty as well.
Yeah.
There's been some really positive exits that happened in the last, say, 12 months, 15 months. I'm sure there's a lot more that we haven't heard about. What's your thesis around this over the next, say, 5 years? Why are you bullish on consumers choosing to go down this path and buying these ingredients, buying these products? I speak with founders raising every day, And they're all telling me the same thing. It's harder than ever to find investors who are actually deploying. And getting access to those leads takes time. Founders just don't have. Every month fundraising is a month burning runway. This is why we created FTW Plus, a community of founders actively fundraising. The world's most accurate agri-food tech investor database, plus connecting you directly to ideal target investors and a community of support and accountability. Guaranteed results or your money back. Apply today at www.joinftw.com/hub.
Yeah, so we're incredibly probably the most bullish on health and wellness. We've probably been the most prolific health and wellness consumer investors in Europe, and we're kind of double tripling down, right? And I can talk through any of our investments, but we've invested both on the CPG side, on the platform side with health. The viewpoint is very simple. The consumer, and we really believe this, really catalyzed by COVID. It was a trend that was already picking up steam, right? And we certainly saw it in the US, where the grocery aisles across categories were getting disrupted, right? For better for you, clean ingredients, clean label, really across the board was a playbook that we were seeing time and time again, where the consumer was just, and particularly the younger demographic, were just looking for food as a medicine, really realizing that everything starts with what you ingest and what you put in your body. And so that trend really took off with COVID and hasn't slowed, right? And so now preventative health has moved into the mainstream and the consumer psyche, right? And so now what we're seeing is health is wealth, where the consumer is now the wallet share, the wallet spend is being flexed away from a lot of the indulgent categories or vices. They've not gone away, and I don't think they will, but have been reallocated to health and wellness and F&B, and in a big way. Health and wellness has been a huge recipient of that capital. And that's why literally across the board within health and wellness, whether it's devices, whether it's ingestibles, topicals, whether it's four-wall services and community-led propositions, everyone's leaning into it because A, people needed community post-COVID for obvious reasons, and two, people are realizing because of the degradation of mental health, and that's a much longer conversation, but people realize that, hey, not only is it a status symbol to be healthier, but people are realizing, my gosh, like if I take care of my gut health, for example, or if I optimize my sleep, it's going to have a profound impact on my mental health, my mood, the quality of my work, my relationships with others, coworkers, family. So we're seeing all of those things converge, and we're seeing even beauty converge with health and wellness. I mean, it's all becoming one. Even F&B is converging with health and wellness, where people are buying snacks or different foods to support this health and wellness journey. But ultimately, it's not that people have fallen out of love with big pharma, but people, the kind of problem solution proposition, but people are realizing that, hey, if I want real longevity, which longevity is, it's a buzzword that's being used, but people ultimately want to live a healthier, happier, and more convenient life. And that ultimately is the mantra at Iris, right? That's our overarching mantra for all investments. So hopefully that answers your question. So our thesis, because we're very top down, bottoms up, is, hey, everything health and wellness related, we do internal reports every week or 2 weeks. Our team puts together really comprehensive, really informative reports where we just as a team get smarter on, okay, what are the trends? Let's identify them. Which ones are here to stay? And the ones that are here to stay, what then one level further are the players that are actually playing a part in those kind of sub-trends. Some trends we think are very short-lived, some we think are here to stay. To answer your question around what's our 4 or 5 year view, our view is it's here to stay. And we have a 10, 15 year view plus view on health and wellness. And the numbers are staggering, and we're seeing it in terms of just our portfolio health and performance across our investments.
So what's interesting to me, first of all, I agree 100%. I'm in that space and devoting my life to it. And I also am, a consumer as well, thinking about that. My father passed away a little bit over a year ago, and he was in quite bad health. So it's definitely in the top of my mind around being a father of 3 kids. Like, how do I live longer? And also, the world is becoming quite interesting it definitely became more interesting the last year and a half.
Sure. Yeah.
What it means to even have work and value coming from work is fascinating. If I am a founder who's thinking about building in the ingredient space, right? Not in the brand space, but I'm thinking about, hey, I want to create ingredients or packaging or something for these consumers, right? How do I study trends that are going to stay with us in 10 years? Like for example, take three of them, right? Is the trend of GLP-1 going to stay with us, or is it going to not stay with us? Is the trend of fuel or grams, like, is that going to stay with us, or is that something that we're going to pivot back towards indulgence, and that's something that's going to incorporate? Or, and the last one that I'm curious about is wellness something that's only for high earners? That to me is very interesting. Is it something that we associate with people who are, earning a very significant amount, that San Francisco biohacker type?
Yeah. Yeah.
Right? He's a London guy who's a startup and he's just like thinking about which supplement he wants to optimize for. Or do you see that this is actually going to start competing with customers that are just middle class, lower middle class? They can start thinking about this as well and get a bigger share of their wallet.
Yeah. So I'll kind of work backwards on the, is health and wellness reserved for the privileged? I think the short answer is yes. I do think that a lot of the propositions today, in terms of how they're priced, can be prohibitive for a lot of people, no question. And a lot of, I'd say a lot of the biohackers and the people who are perhaps more health conscious and perhaps a little bit more, if you want to label it vain or whatever else, might be the more affluent. But I would kind of, to my earlier comment around, the wallet share, right? What we're seeing is people that typically had a budget reserved for, dining out and alcohol and cigarettes or for whatever else, are really dialing it back, particularly on the drinking. So it's like we don't have the viewpoint that alcohol is going to go away by no measure. I drink socially on occasion. It's more people are dialing it back. And so rather than spending on some other kind of items that we typically do, whether it's fashion, whether it's booze, whether it's travel, people are dialing it back and reallocating it to health and wellness. So that's why I think it's actually straddling a much broader income demographic than we might suspect. Sure, like the high earners are perhaps representing a larger share of the total revenues generated from health and wellness. But I think we're seeing the data that actually there are a lot more people that are leaning into it, just making adjustments and flexing. I would also say that, putting CPG aside, health and wellness, living a healthier life isn't necessarily, in our view, inherently prohibitive. So I think like just eating better food, and sure, organic foods, particularly in the US, are much more expensive, but just leading a healthier life, whether it's exercising more, drinking more water, being more selective in terms of what you drink, watching out what you eat and having a more balanced diet, without even buying any CPG products on health.com, like you're already living a healthier life and you're supporting longevity, right? So just to be very clear. So hopefully that answers that question, which is it is nuanced. And yes, I do think that the affluent class is still representing a large piece of the overall equation or market. But I think the middle class and even those, the kind of lower social, income demographic are leaning into it more because they see the value and the importance of it.
Mm-hmm.
In terms of how you folks can kind of, and the listener can get smarter on trends, founders that have businesses that kind of sell ingredients. I think, listen, the consumer, as you know, across age demographic, and we're even seeing this in terms of the 65-year-old plus the boomers, consumers getting really informed and smart. And now with AI tools, they do a lot of work. They're very discerning. They're very fickle. And, in the kind of the wake of this proliferation of CPG products, a lot of which have, great branding, solid execution, zero product differentiation at the formulation level, at the ingredient level. And in some cases, I'm just looking in the realm of health and wellness, big health claims with nothing to substantiate it. And there are a lot of businesses that ultimately substantiate the health claims by saying, hey, we've got clinicals, but at the ingredient level. The reality is like some of these formulations feel almost commoditized and it's really a brand play. And that's something that we have to sift through. It makes our life a bit harder because there's so many brands out there. But when you kind of lift the hood, it's really hard to find that point of differentiation. So for the founders that are selling novel ingredients, are really putting forth true science, IP, and innovation, I think you're going to have a real edge because a lot of these founders, a lot of these businesses are going to want to do work with these founders, with these products, with these suppliers, because founders, consumers are very discerning. As I said, they want efficacy. When it comes to health and wellness, people are very impatient. They want efficacy and they want a very, very quick feedback loop. So if you're a longevity product that's high price point and you're promising results that are going to take, half a year to a year, if not longer to see, I think it's really hard to drive repeat. I'm not saying it's impossible, but it's harder to drive kind of cost-effective repeat. So
Oh,
any innovation around the ingredient level, I think is today is very
I'll
important.
just add to what Florian is saying from my perspective is that, you would never, somebody who takes a GLP-1, they know the dose that's in that shot, right? It's pretty clear.
Yeah.
But when a lot of people take supplements, they don't understand that actually the dose that the study was done is very different than the dose that they're taking.
Yeah.
Right? They say it has a following ingredient, and it does, but it really depends about how much of that ingredient is in that supplement, right? And that's where it gets people they look at, okay, it has a lutein. Well, what percentage of that? Because that was actually the study was done a certain amount of value of that ingredient, similar to
Yeah.
a GLP-1 shot has a certain amount of the ingredient that's you're consuming to the shot. So if you're a producer of ingredients, like if you can bring back that transparency back to the consumer on the product label, I think that'll drive sales for you.
100%. I think GLP-1 is an interesting one. For your benefit and listeners' benefit, we're long GLP-1. I don't think, we don't think it's going away anytime soon. And we've been thinking this for several years. We're obviously starting to see some of the impacts it's having, obviously in terms of, muscle degradation, in terms of the impact it has on the skin, on the face. So you have like Ozempic face. So the beauty industry is piling into that. So you're seeing all these different effects. So I think we're ultimately trying to find propositions that support the GLP-1 user ultimately.
So what would be great for the last section of the conversation, take us through some of your recent investments and maybe give us your thesis behind it. Because I think that's a great way of driving what you believe actually, splashing into in a specific application. So maybe just the last one or two. Hey, what was your conviction around it? Why did this fit your thesis? What did you see about the founder or the product or the category that really caught your eye?
Yeah, it's a fair question. So, I mean, as I said earlier, we're top-down, bottoms-up investors. So once we've identified a particular trend or theme, or even a gap in the market, let's say, where certain consumers, demographics we feel are underserved, this is where we lean in. So a perfect example of that is Lucille, which is a seed investment we made earlier this year. Senior nutrition. So they have two SKUs, chocolate and vanilla. Essentially it's a senior, it's a nutritional shake for the consumer that's 65 years of age plus. The business is really catering exclusively to the US consumers today. It was founded by Jess Hagani, who's an incredible founder, super sharp, has a very authentic story in terms of how she decided to pursue this path. And it was born from her experience with her grandmother who, lacked effective everyday nutritional solutions. And in terms of the incumbents that were on the shelves in retail in the US, without naming names, they were riddled, and there are very few, but the large incumbents were riddled with products that had seen little to no innovation in the last 20, 30 years. And when you looked at the ingredient profiles, you couldn't pronounce half of the ingredients, just full of preservatives, sugars, just really on the surface, not very healthy. And when we were talking about health and wellness earlier, we realized that, hey, most of the CPG propositions today, from a look and feel, storytelling, comms, and formulation standpoint, are really manufactured and geared towards a younger demographic. And we felt the seniors were really just being left out. And nothing was really formulated specifically for seniors who, when they reach a certain age, need certain doses of proteins and minerals and fibers because of the muscle degradation you see at an older age, specific minerals and quantities of minerals, to support their mental, the integrity of their mental state. And so Lucille was an interesting proposition because it's a proposition with 10 ingredients, and you can pronounce all of them and you know all the ingredients. It's got the absolute right doses of minerals, vital minerals, proteins, and fibers, and it tastes amazing, right? We say with every investment of ours on the CPG side, product. Like, you have to lead with product. If the product doesn't work and if the product doesn't taste good, flavor profile is so paramount, you don't have a business. And so she spent a year and a half formulating this and finally launched in March of this year, and has been very well received by the market. And interestingly enough, we really thought a lot of in terms of the consumer that would be actually making the purchase, it'd be more the caretakers than the actual seniors themselves. And early indications point to actually it's the seniors themselves who are going online and buying the product and repeating because the product tastes so good. And it's such a conveniently packaged product. So that's a perfect example where we saw a huge opportunity. there was no innovation in enormous categories. Seniors today represent about 16% of the US population. With birth rates going down in about 5-6 years, seniors will represent, close to 20% of the US population. And yet there's no innovation and no VC capital supporting that demographic. And so the only real comp in terms of innovation that we've seen is Kate Farms, and it traded for, our estimate is roughly $1 billion to Danone. So for us, that's kind of the underwrite for Lucille is huge white space, huge TAM, and it's going to come down to execution because the product's there and the founder is fantastic. So that's a perfect example of like top down, identifying a gap, going after it. We wouldn't have made an investment if we hadn't found a proposition, founder, and product that we thought was standout. And that's why when we finally saw Lucille, it was a no-brainer.
Bertrand, when you were, did she reach out to you or did you find her? That to me is also very
No, we reached out to her.
How did you find her?
Through our network. In that instance, I reached out to my angel network and was connected by an angel investor who wasn't invested in Lucille per se, but had heard about Jess, and I started I kind of went after it and finally was able to connect with her. And it was, it was pre-launch, which for us is very atypical. And we were so impressed by her mission, her ability to articulate the business plan, the mission, and the ambition so clearly that it was kind of a no-brainer to place a bet. And the view is to support her across the next several rounds through to exit.
Yeah, amazing. Florian, first of all, I feel like this, as we're like running towards the end, even though we should this is like a part one of a part two that's happening definitely in 6 months. Like a big question that comes up, there's so much appetite right now in venture for a certain asset class, which is, the 2-letter word, right? And or defense tech, right? So it's the cyber AI, How do you go to your LPs and say, hey, I have a good path for returns for you. Like you should trust me with your cash because I have a path for returns that not only are good, but they can actually be superior to that of an AI play or a defense tech play. Can you take us through that? Because I think we want to see a lot of optimism around the space. How do you have that conviction?
It's a great question, Alex. And it's one that we're on the fundraising trail. We get asked this time and time again. I think, AI is the shiny new object. And of course, investors are always chasing the highest yield. The reality is simple is, first of all, there's a lot of money chasing AI. There's a lot of money. And I, by no measure, think there's, it's kind of overly frothy and there's going to be a bust like there was in 2000. AI is here to stay. So I'm not even going to digress into AI. Like, absolutely, it's very, very compelling. The very simple fact is consumer as a category is never going away. Consumers will continue to consume. And a lot of people have shied away from consumer because without sounding pompous, it's not for everyone in terms of, one thing's having the investment acumen and the financial know-how to be an investor in the category. Another thing is to have brand sensibility and to really have your ear to the ground in terms of where the trend's headed. And we really pride ourselves on having that brand sensibility and ears to the ground in terms of what does the consumer care about today and where are they headed? So consumers will continue to consume. What the difference being is that categories are going to evolve. Propositions will evolve, ingredient profiles will evolve and innovate. And that's where we want to be. We want to be there to support the next gen. And the reality is, if you look at Europe and you look at the competitive landscape of institutional consumer investors, true consumer specialists, it's tiny. We're, 5 to 10 max, but truly consumer only in CPG as opposed to like consumer tech, we're like 5 or 6. And so the US is a slightly different picture. There are a lot more funds, but relatively speaking, compared to the number of funds that are participating in defense and AI, it's day and night. And so I think that is a natural moat for us. And like, we're very happy with that. And so if anything, we're seeing a deluge of new propositions popping up on both sides of the Atlantic, and there's only so much capital we can deploy. So we like that imbalance. I mean, I think there should be more institutional capital investing and supporting the consumer ecosystem. But all to say that, if everyone had access to an Anthropic and those kind of returns, like, we wouldn't be in consumer. Everyone and their mother would pile in. The reality is that's not how it works. But we absolutely feel very, very comfortable promising, in particular, our track record to achieve a 4 to 5 times on a fund basis. And that's a really, really good MOIC. And there are very few funds that are like tech funds, consumer funds, generalist funds, everywhere between VC up to PE. Like that's a big number to achieve at a fund basis. And we feel very confident. And the reality to you were alluding to, if you look at the liquidity events the last 18 months, the big headline visible trades, most of them have been in consumer in terms of real exits, not like step up in growth rounds. I'm talking like real cash liquidity events. Most of them have been consumer and CPG for very, very healthy multiples. And investors have made a lot of money and founders have made a lot of money. And so it just shows you that investing in a stable category like consumer, and when you see how much consumer represents within the S&P 500, it's such an enormous category. It's just not going away. And there's liquidity, and that's really important for us. If there wasn't liquidity, we would feel very challenged. So we feel like we're in a good place. And it's, again, as a category, it has a lot of longevity.
Yeah. Well, Florian, last question I have for you, because I know you just had successful fundraising around yourself. Any books or resources that you felt made an impact on your journey? Because obviously fundraising for a new fund is not easy in this environment, right? There's a lot of competition, like you mentioned, around maybe more buzzier type of acronyms. Anything that you felt was really strong for you, besides obviously your family, your support network, that made a difference?
Yeah, it's a good question. I mean, for us, from a fundraising standpoint, candidly, I haven't been leaning on books. If anything, there's nothing like rolling up your sleeves and just doing it, like learning on the go. But really, what's been really, really helpful is having conversations with other founders and other funds, and learning from other people's mistakes. Just like really networking and having the kind of the humility and being able to be self-critical and asking for advice from as many people as possible, because there are a lot of things that you can avoid just by learning from someone else's experience. So you can do that just by outreach. I mean, I try to get back to folks who reach out to me even on LinkedIn and kind of offer up 10, 15 minutes of my time and just share any of my personal learnings. But I think like being proactive in reaching out to folks who've done it and done it well, and folks who haven't perhaps succeeded the way they would have liked, there's always learnings from both sides. And then the second thing is, and now, in the age of AI, there's so many podcasts, so many interesting interviews, podcasts such as yours. I listen to podcasts all the time when I walk from meeting to meeting, when I exercise. There's so much content. There's so many learnings to be consumed out there today. I think folks should be all over it. And I think that hopefully that should help founders or arm founders with a lot more data points to be dangerous as they embark on their capital raises.
Well, this has been, like I said, it's my first, and I guarantee you, I'll never forget it.
Not the last? Okay. Well, I'm glad.
Absolutely not. This is it.
I'm glad.
Thank you, Florian. It's a really pleasure to
Alex, thanks for having me. Speak soon.
One more thing, don't close this episode yet. If you got value from this conversation, here's what I need from you. A 5-star rating, 1 comment, 20 seconds of your time. That's the deal. A 5-star rating means more founders find this content, and every time a founder raises, all boats are elevated. Every week, I pick one random comment and send that person a complimentary copy of Investment Climate, the book. 50 sales playbooks from founders who actually raise money during the fundraising winter. Real strategies, real closes, real numbers, not theory. So if you want a copy, comment below, and if you haven't followed the show yet, do that too. And if there's a guest you want us to bring on the show, just drop us a note or send us an email. We'll read each and every one. Until then, keep on raising.